Good afternoon, everyone. This is Mazen Al Sudairi from Al Rajhi Capital. Al Rajhi Capital is glad to host Arabian Drilling Q2 2023 earning call. Welcome all to the call. And now I will hand over to the management.
Good afternoon, everyone, and welcome to Arabian Drilling's earnings call for the second quarter 2023. Our thanks to Al Rajhi Capital for hosting this call. We have recently announced our Q2 financial results, and the documents are available on our investor relations website. As usual, we must start with a disclaimer, so I invite you to read it at your convenience. Following the presentation, we will be pleased to address your questions. As we kick off this presentation, I would like to take a moment to introduce our speakers for today's call. First, we will hear from our CEO, Mr. Ghassan Mirdad, who will provide an overview of our performance. Then, we'll have our CFO, Mr. Ober Lafoy, who will take us through the company's financial performance for the second quarter and 6-month period. The agenda for today's session will cover different topics, including our accomplishments, an analysis of the competitive landscape, a review of our operational and financial performance, as well as forward-looking guidance, before we open the floor to your questions. I would like now to hand over to our CEO, Mr. Ghassan Mirdad.
Bismillah ar-Rahman ar-Rahim. Thank you very much for the introduction, Raed. From sunny London, Assalamu alaikum, heartfelt welcome to all participants joining us for this earning call. We will begin with a brief overview of what happened during the quarter. So looking at a glance, we are encouraged by the progress showed in our financial and operational results to close the first half of the financial year. Starting with operation, rig activity this quarter remained identical to last quarter, with 44 operating rigs over a total fleet of 47, which resulted in a utilization rate of 93.6%. Our non-productive time increased slightly. However, our rig maintained a high rig efficiency index of 93.6%, with 25 rigs rated as superior performers. Finally, we have seen significant improvement in our rig move efficiency in the land segment, with 1.3 days saved per rig move in quarter 2 versus 0.2 days last quarter. On the safety front, I am pleased to report that we have improved our total recordable injury frequency rate performance, and we continue to record 0 environmental spill this quarter. We also just received 3 ISO certificates demonstrating our commitment to safety processes and environmental prevention. Moving to the financials highlights, which will be detailed by Uber later, our Q2 revenue of 791 million SAR was in line with that of Q1 on a similar rig activity. Our EBITDA improved by almost 1%, mainly due to improved rig move performance that represented approximately 40 days of additional revenue compared to last quarter, as well as improved cost base, particularly in the land segment. Our Q2 net income contracted slightly by 1% compared to last quarter as a result of high depreciation cost and financial charges. Net cash from operation was 348 million, showing a 26% decrease, bearing in mind that Q1 included a one-off exceptional item for the collection of the mobilization fee of the 2 offshore rigs AD-110 and AD-120 that started in Q4 last year. We closed Q2 with 1.8 billion of available cash, which is slightly lower than Q1, driven by the completion of the shipyard activity for our 3 new jackups that have just started. Shifting our focus to growth, the strategy we established at the beginning of the year is in now full swing. I would like to recognize our project team that has done an outstanding job to deliver the 3 offshore rigs safely, on time, and on budget: AD-130, 140, and AD-150. This was a key goal for 2023, and all 3 rigs have started their 5-year contract with Saudi Aramco. As announced this week, we were delighted to have landed a milestone win for Aramco unconventional gas project. We have won 10 out of 13 tendered rigs. All 10 new rigs will be new build, and we have already started the procurement activity. The win will significantly increase our backlog, as we will see later. This is a major growth area for our land business, as natural gas is an essential part of the successful energy transition globally. We are excited to be playing our part in it. The major investment to develop Saudi Arabia's gas resources through infrastructure will benefit the economy, employment, and support the government's carbon emission reduction targets and the production of low carbon fuels. We remain very positive about the business outlook, influenced by the recent market and industry development. Our backlog addition in Q2 includes marginal contract extension and awards. However, in Q3, we expect the backlog will significantly increase, as we will include the 10 new rigs contracts for unconventional gas, and we are in a very good position to finalize the extension of the rigs that are rolling off contract in 2023. As mentioned, our 3 jackups started operational in July as planned. This was achieved despite major challenges across supply chain, logistics, and human resources. This is testimony of Arabian Drilling team outstanding performance and strong relationship with our suppliers. On the land segment, we believe that Saudi Arabia growth will continue to be stimulated by the unconventional projects. Our backlog position decreased from 8.1 billion to 7.6 billion in Q2. We added approximately 150 million to our backlog during Q2, mainly attributed to contract award and extension of 4 land rigs with SLB and with Baker Hughes. Baker Hughes was added as a new client last year, and our performance to date has resulted in a request for more rigs to be added to their fleet, bringing the total from 3 rigs with Baker Hughes to 5. Our backlog as of today is 56% offshore and 44% onshore. The additional 10 rigs for the unconventional contract will add a backlog of approximately 3 billion SAR. As mentioned earlier, our REI remains strong. Our non-productive time was slightly higher this quarter. However, the overall 12-month rolling average is improving and going in the right direction. On the rig move front, you will recall that we highlighted in the last earnings call a low rig day saved number. This was due to poor weather and higher maintenance during the last quarter. However, we see on the top right graph a clear improvement this quarter, and even with a fewer rig moves at 38, we were able to save 1.3 days per rig move. Rig activity and utilization remain stable, as the 3 jackup will only kick in during Q3. With that, I will now hand over to Hubert to cover the financial highlights. Hubert?
Thank you, Ghassan, and good afternoon, everyone. I will just would like to pause it here to see if the slides are we're in sync on the slides. Yes. Okay. Very fine. So let us start with the consolidated view. We have closed the quarter with a revenue of 791 million, in line with the previous quarter, while reflecting the same level of rig activity. In contrast, the year-on-year comparison is much more striking, with a 25% increase year-on-year. And this increase is due to higher rig activity. We have had additional jackups as well as additional land rigs in 2023. Our Q2 EBITDA of 335 million represented 42.4% of the revenue, with a quarter-on-quarter improvement of 90 basis points. This improvement was mostly due to our land segment regaining better operational performance and fewer maintenance activities this quarter as opposed to the last quarter. This EBITDA margin remains in the range of the low to the mid-40s as expected. We have seen a slight contraction on the net income in Q2, mainly due to higher financial charges, as the SIBOR rate for the next coupon payment was reset in February. In addition, as mentioned by Ghassan as well, our depreciation cost was also slightly higher this quarter in Q2. On the CapEx side, we have seen an acceleration of the CapEx spending in Q2 versus Q1 due to the completion of the shipyard activities and mobilization of the 3 new jackups that started in July. In addition, we have also completed shipyard activities around the 5-year recertification of our MPSV 8020. Now, looking into the segment reporting, let's focus on the offshore first, which is on the left side of the slides. So for offshore, we have a flat revenue reflecting maximum capacity utilization of 9 rigs working with no significant change in status or day rates quarter on quarter. On the cost sides, we have seen a slight increase in the cost in Q2 as opposed to Q1, reflecting some startup costs for the 3 jackups, mostly compensation costs related to getting the required drilling crew on board ahead of the start of the rigs. On the land segment, we have a slightly improved revenue, mainly due to less maintenance activities that we have incurred in Q2 compared to last quarters. And this represents approximately 52 days of additional day rates this quarter compared to the last quarter. Now, on the cost side, we have seen some solid improvement in the land cost structure quarter on quarter, which again is mostly resulting from a better operational performance on the rig move, as highlighted by Ghassan, as well as fewer maintenance activities that were laid this quarter compared to the last quarter. Now, if you look at year on year, the land segments include incremental cost due to the high maintenance activity in Q1 that we have seen, as well as the cost of the retention plan that was introduced in the second half of 2022, which is coming through this year. Now, moving on to cash flow and net working capital. Our net cash flow generated from operating activities was 348 million in Q2 versus 472 in Q1. However, as Ghassan mentioned earlier, Q1 included a one-off exceptional item related to collecting the mobilization fees of AD 110 and AD 120. Now, excluding this item, our Q2 normalized cash flow would actually sit higher than that of Q1. From a cash position, we closed Q2 with a balance in excess of 1.8 billion, which is about 7% lower than the last quarter. And we expect this cash to deplete quickly over the next 12 months as we are building the 10 new rigs for the unconventional contract. Our net working capital, which is on the right side of the graph, was unusually low at the end of Q2 at 5%, sitting at 5% of the revenue, which is mainly due to an increase in our trade payable. The DSO by itself was stable at 68 days. Finally, looking at our net debt and our leverage ratio, we have increased our net debt position by 23% between the end of Q1 and the end of Q2, which basically represents the change in the cash position quarter on quarter. There was no change in our total borrowing position other than the portion of the accrued interest for the periods. Alongside the future cash depletion that I just mentioned, we can expect the net debt to significantly increase over the next 12 months to fund our CapEx, and we expect to draw on an additional bank facility that has already been secured at a very competitive price. Our net debt to EBITDA of 0.7 continue to be healthy, but will increase as we enter the execution of our next CapEx growth plan with the 10 new build rigs. Now, moving on to the guidance. Our revenue guidance remain unchanged at between 3.3 and 3.5 billion SAR for the full year 2023. And let me add here that this guidance does not include any revenue stream for the new 10 rigs that will materialize only next year. The full EBITDA margin is set to remain at the current level. We are updating our CapEx guidance to include the portion of the CapEx that we expect to spend in 2023 related to the 10 new rigs. Therefore, we now believe that our CapEx spending for the full year of 2023 will be around 2.2 to 2.4 billion Saudi riyal. Finally, in terms of dividends, the board has recommended a dividend of 2.53 riyal per share based on H1 net income, which is consistent with the previous guidance. This dividend will be paid out in Q4, subject to the shareholders' approval. And this concludes my section. I will now hand it over to Mazen from Al Haraji for the Q&A session.
Thank you for the comprehensive presentation. And now we'll start the Q&A. I see Saleh. Saleh, you are unmuted. You can start.
Arabian Drilling Management and Rajah Capital for hosting the call. This is Saleh Rakaf from GIB Capital. I have only one question regarding the onshore revenue. So, as you mentioned, that onshore revenue increased Q over Q by 2%. This is mainly due to the less maintenance days. However, the number still below Q4 revenue by around 4%. And I think this is mainly linked to the days savings, which was 2 days savings in Q4 compared to 1.3 days in Q2. So can you just shed some light on the normal levels in terms of days savings, given we have been seeing a quite fluctuation in the past quarters in this ratio?
Oh, I'll check that. Yeah. Yes. There is one change in the rig activity. If you look at Q4 compared to Q2, which is AD29. AD29 was a land rig that was working during the full of Q4. And if you remember the call that we had last quarter, we said that AD29, the contract was terminated, and we deployed AD29 to first drill a couple of rigs for SADA, for the Saudi Arabian Drilling Academy, and then we'll use AD29 as a training facilities. So the difference will also come mostly from having taken one land rig off in Q2 compared to Q4.
And you were right. We had a lot more rig moves. There was a lot more days saved during the Q4, and as well, February is 2 days less of revenue as well.
Okay, thank you very much. That's it from my side.
You're welcome.
Thank you, Saleh. Now we'll start with Akrash. You can start. You are unmuted.
Congratulations on the results and congratulations on winning the new Jafurah tender. So I have 3 quick questions. First one is if you can share what is the capex requirement that you'll have for the 10 new rigs, since these will be newly built. The second question is if you can share the EBITDA margin for the leased rigs, the AD 110 and 120. And third question is, I'm new to the sector, so a general question I wanted to ask, then what happens when, let's say, Aramco or let's say Saudi Arabia announces that there'll be a production cut that will be doing for oil. So in that case, what happens to the drilling? Do you keep drilling and keep getting revenues, or will there be a decline that can happen? So these three questions. Thank
Okay,
you.
so let's start one by one.
So the acquisition cost?
Yes,
Yeah. So you want me to? So
Yeah, go ahead.
Look, so in terms of, so there are different rigs in the 10. I mean, there's 10 rigs package. It's different types of rigs. You have rigs that are skidding. You have rigs that comes with higher spec in terms of well control equipment. But to be in the ballpark, I would say that the acquisition cost, or sorry, the building cost of those rigs is about from $40 to $50 million each. So this is the kind of capex that we'll be looking at deploy over the next 12 months. You had a question on the EBITDA related to the offshore.
110, 120.
Yeah, 110, 120.
Because they're bareboat chartered.
Yeah, so those are the two rigs that are bareboat charter. They start their contract in Q4. We don't particularly disclose EBITDA at rig level for confidentiality purposes. But what I can tell you is that I mean, I don't know how much you know about the drilling sector, but offshore. The offshore EBITDA is basically accretive to the overall EBITDA of the company.
Yes, so I just wanted to have an idea whether these rigs are getting more margins than your mid-60s for offshore, or are they like lower than that? Just to have an idea.
So those rigs were contracted at their rate, which were north of 100,000. So they are getting the EBITDA that you would expect one rig in the market would get in those days.
Oh, thank you. That's helpful.
I mean, just to add to what Ober said, the reason why is we managed to secure it during, as bareboat charter during COVID. So it was a good pricing as well. So on the last question, in terms of you need to understand the way our client, Saudi Aramco, which is the biggest client producer in the world, they don't react to these small changes that happens every now and then. They set a plan, which is, the Saudi Aramco wants to go to 13 million barrels per day, sustainable. So they don't get affected. So this is a goal that needs a lot of drilling, so they don't get affected with cuts. So we don't see, when you have these small cuts that happen during the OPEC or OPEC plus, affects the day-to-day business, because these are long-term plans that Aramco decides and they march straight.
Thank you. That's helpful.
Thank you, Akrash. Now we'll go to Ricardo. You're unmuted. Ricardo, you are unmuted. You can start. We can't hear you, Ricardo. We'll come back to you. Okay, we'll come back to you. Now we can go to Abdulillah.
Hello,
Hello? Yes, we can hear you.
can you hear me?
Yes.
Assalamu alaikum. First of all, congratulations on the strong set of results. I just have a couple of questions. The first one is more of a high-level question. Given where the tight market on offshore and the increasing demand on onshore rigs, I just wanted to ask from the management view, what would be the scenario that would take day rate lower over the midterm? So that's my first question. The second question, if you could,
Can you repeat the first question, please? Just to make sure I understand you.
so we continue to see a hike on the day rates
Okay.
across offshore and onshore. I just want to get the management view. If we were to reverse that direction and we start to see declining day rates, what would take for that reversal to take place?
Okay.
So that's the first question. The second question, are you anticipating that the operational cost per rig for the unconventional rigs to be any different than the onshore conventional rigs?
Very, very good question. So let me tackle the first one. So if we split the segments, so offshore and land to discuss on the rates for the first question. So for the offshore, if you look at Saudi today, Saudi Aramco have secured the rigs that they want for offshore. There is not much available rigs in the market at a global level. So Saudi Aramco managed to secure the rigs that they want for offshore. So the only reason that the price will continue going up in Saudi is if Saudi Aramco requests more rigs. And because there is not enough rigs in the market globally, then that will push the price up. But we don't see, I think Saudi Aramco have secured the rigs that they want. So I don't see this going forward in Saudi. However, if any client at a global level is requesting for a rig, the rigs are, I mean, it went up also to the 180 or 190 outside of Saudi. And the reason why, one is there is no availability of rigs. Number two, the usual contracts at international level, they're not on an annual, like 3 years, 4 years, 5 years. The contracts are 4 wells. So there's a huge investment from the drilling contractor to provide the rig only for 4 wells or 2 wells. And that's why the price is a lot higher than here in Saudi. On the land, it's very competitive. And it's I don't see going to be a spike up or down on the rigs for the land. They only see, I mean, we see a single-digit increase, and I think that's mainly of support of inflation more than not more than that, to be honest.
I believe there was a question on the OPEX. You want
on the OPEX for? You want to start, then I'll add.
So look, I mean, at this point in time, we have modeled the OPEX for the unconventional to be the same as the conventional. Saying so, we believe that there is potential upsides in terms of economy of scale, synergies, etc. It's just that those upside at this point in time are not known because we haven't really tested it. So, so you want to add?
So yes. So this win is our first penetration to the unconventional. So it's very, very key for us, specifically that we're going to see growth on the land. There will be more work to be added, more rigs to be added on land. So what you can, if you look at factory, you know, when in the unconventional, it's factory drilling. So when you have this kind of factory process, you can eliminate a lot of cost or fat in your organization. And this is what we didn't model yet. Once we have the rigs and we start operating and having a factory drilling, then we can see how much we can save some of the costs that we usually use in a conventional rig. As mentioned by Ubaid, today we just modeled the cost as per a conventional rig.
Clear. Thank you very much.
You're welcome.
Thank you, Abdullah. Now we're back to you, Ricardo. You are unmuted.
Unfortunately, we can't hear you, Ricardo. Yeah. Unfortunately.
To invest in a new mic.
Sorry.
Yes.
Yeah. You hear me now?
Yes, we can hear you.
We can hear you.
Okay. Sorry, I had some issues with my connection. So thanks for taking my question, Ghassan and Ubaid. First question is on the new contract. I just wanted to get some color on how was the competition for those rigs. You did a phenomenal job on getting the 10 rigs out of 13. It's a lot higher than your standard share on the land rigs in Saudi. So how do you see the competition? And then 2 follow-up questions is the first, on the press release, you mentioned that those rigs should start generating revenues in the 2nd quarter of next year. So how do you think about the timeline for the general revelation? Or the most on the 2nd, 3rd quarter, or is it more spread out? And then the final question on my side is how to think about execution from Arabian drilling, as now you have quite a significant backlog and a lot of new rigs to enter operations, what would be your appetite for potential incremental contracts in the short to medium term? Thank you.
Okay, that was a lot of questions. So the first
was about the competition.
I mean, being in this unconventional is, I think it's key for any drilling contractor. So a lot of the contractors who exist in Saudi who have participated in this, and I think it was key for everyone. And I think the strategy team, we've done a good job in terms of putting ourselves in the right spot to win 10 out of 13. Now this 10 out of 13, just to understand, half of it is skidding, which is the unconventional factory drilling, and the other half is conventional. It's in the unconventional group, but to explore for unconventional fields. What was the other question?
There was a question on the revenue flow. So I guess the revenue flow is So the first rig. So it's a phased delivery, right? So not all the rigs are going to come into the first. We expect the first rig to start coming in Q2, and then it's going to be a phased delivery of the rigs. Each of them has a different delivery date, and what we meant is, the fund of the revenue will really hit H2, right? So it's going to be there's not going to be any substantial increase related to those rigs in Q2. It's just we'll see the start of those first rigs in Q2.
The arrival will be Q2, but the revenue stream will start in H2. Yeah. And there was
a question on the execution with all this backlog. How are we going to execute?
Yeah. So I mean, this is a very good question. I mean, if you look at the supply chain, the suppliers, managing the inventory, human capital, making sure you have the right crews. It's a constraint on the whole sector, not only on drilling contractors, service providers, and as well our clients. So the good thing, as mentioned in my presentation, our strong relationship with our suppliers played a key role in the offshore to deliver the offshore on time and on budget. And I think this will come again with the 10 rigs. The other part is human resources. So if you look at our headcount on the rigs without the offset, which is the transportation, we're shy of 5,000. And if you want to add the 10 rigs, each rig, let's say give 75 employees, so 75 multiplied by 10, that's 750 crews. I mean, the team that needs to be added for the 10 rigs. So you're talking almost 16% of my population is going to be increased. So and I just added as well the 3 rigs. So you can imagine the amount of people that are recruited and trained. So today we're focusing a huge focus on training. So AD 29 is purely now focused on new crews coming in, getting the right exposure before they get deployed to the field. And as well, we have just acquired, I mean, this was last week, we just acquired a new facility to cater for our training. We acquired it as Arabian Drilling. It will be announced on the social media. But this is one bottleneck that we think we can debottle because we control the training ourselves.
That's very clear. Thank you.
Thank you, Ricardo. Now we'll go to Ibrahim. Ibrahim, you are unmuted.
My voice, please.
Yes, we can hear you.
Okay, sounds good. Congratulations, management, on securing the 3 billion contract.
Thank you.
My 2 question is regarding the if I want to see the growth in the revenue from onshore side. Since last year you renewed almost 21 rigs, but if we can see the growth from year over year, it's almost 5%, like as mentioned by my colleague before. And also I want to see, if I'm not mistaken, you renewed at like double-digit growth from the last contract. I want to see is there effect from that side? Because I don't see margin are responding, especially operating. Gross margin is increasing like almost 40 basis point. I want to hear from you, like can you
Yes.
shed a light from that side? Also,
So let's answer this question. So we don't. So just to make sure. So
Sure.
you're right. The double digit was in the offshore market. On the onshore market was a single digit. It barely covers the inflation. So mid to high single digit the land rig. So the double digit was on the offshore that we had. Just to clarify.
That's
Okay,
correct.
so-
Absolutely correct. Yeah.
Yeah.
so it should make margin better, right? Since your cost is the same.
Well, the cost is not exactly the same. What we've seen on the land side, we've seen a high, mid to high single digit increase on the day rates. But then we also have seen, a similar increase on the cost side as well. So there is not substantial difference. I mean, year on year, there is no substantial difference on the land margin.
Yeah.
Now the offshore is a completely different story, but on the land, there is not any substantial difference.
I think most of the single digit increase was wiped out with the inflation that we've seen.
Yeah.
Sounds good. Okay, so my second question is regarding when we had the first quarter call, you mentioned that the new renewals you will talk about in August, if I'm not mistaken.
Yep.
Is there any
Yes.
update from that side?
Yeah. So we have six, seven.
So five, we have, so we are.
Total six.
Okay. Yeah, we have a total of 6 rigs
Total
rolling
six.
off contracts.
Yeah, out of which we have total 6, out of which 5 were in the final closure to be renewed. And I think this will be. I mean, once it's renewed, we'll announce. But they're in the final signature state. And one will be still is going to be kind of afterwards, right? The last one, because the 5 is with Saudi Aramco, and the 6th one is in Khafji. So it's as well in the negotiation phase to renew.
But I mean, overall, we're very confident those rigs will be extended.
So it will be the same thing. Like there is no margin has from that side because it will barely cover the inflation.
So out of the 5, 4 are land. So you're right, you're correct, and 1 is offshore. So the offshore will have a better increase than the land.
Correct.
If I'm not mistaken, Mr. Hassan, in the report it mentioned that 2023, 6 lands and 2 offshores, right?
6 land.
Yeah, 6 land contract ending date by year.
Yeah, go back.
6 in 2023 and 2 in 20.
Let me go back to the slide.
Yes.
We're going back to the slide. So
Yes.
yes, so 6 land and 2 offshore. Yes. So so yes, you're correct. So out of the 8, 7, so the land and 1 offshore is with Saudi Aramco. That's going to be in the final stage, and 1 offshore with KGO, which is Khafji Joint Operation. That is taking. It will be a longer time to sign, but it will be signed this year as well.
Okay, sounds good. Thank you.
Thank you, Ibrahim. Now we go with Jonathan. Jonathan, you are unmuted.
Good afternoon. Thank you very much for the presentation.
Thank you, Jonathan.
Thank you.
Congratulations on the new contract award.
Your voice is unclear, Jonathan. It's unclear.
Can you hear me better now?
Yes, much better. Yes.
Okay. The new.
Oh, we lost you.
He's not here with us. Now we'll go with Ibrahim. Ibrahim, you are unmuted.
Hello.
Hello.
Am I audible?
Yes,
Yes.
Ibrahim. Assalamu alaikum.
Great. السلام عليكم. وعليكم السلام. معكم إبراهيم عطية من أشمر السعودية. I do have a few questions. The first one, just follow up on my colleague Ibrahim question, the margin profile. So just for the fact that we have two segments, each has different margin profile. The onshore versus the offshore, one is the 30s, one in the 60s. Just for the fact that offshore contribution increased from 28 to 38, I would expect higher margin than what you reported during the first half, or higher margin expansion than what you reported. So am I missing something? Is there certain one-offs you mentioned the pre-operating cost as well, and you mentioned also that the land rig margin is flattish year on year because the inflation in cost is compensated by higher day rate, etc.
Yeah.
So what's the story in the offshore if the pressure is coming from the offshore other than the pre-operating expenses? That's the first question.
Okay. So yeah, so no, you're absolutely right. I mean, we have seen some pre-operating. I mean, to start up an offshore rig is not a walk in the park. I mean, you have to have the crew ready, so you have to get you need. So there is a lot of pre-operating costs that are hitting the P&L months before the revenue stream starts flowing. So you have seen that. You have seen that in H1 as we started 130, 140, 150 that just started in July. So you have a couple of months where the costs are hitting you, but you're not getting the benefit of the revenue. So that's one thing. The other thing as well is I think that we have seen some cost escalation as well, particularly on the offshore. The offshore, I mean, the manpower of the offshore. I mean, I think Ghassan has alluded to that, but it has become a very, very scarce resources. And one of the things that we did in particular, we have introduced a retention plan just to make sure that we keep the key people, offshore. So it's a combination. It's a combination of those two elements. Now, saying so, the pre-operating costs are a kind of a one-off. I mean, once you have your crew and everybody's working on the rig and you get your revenue, then it's business as usual, I would say.
Yeah.
You want to add?
No, if I would add, I mean, we had to put a very strong retention plan because we've seen our competition who's growing very fast in Saudi. They're finding it difficult to find good candidates, and the best place to come to is Arabian Drilling. So they were trying their best, and we're trying to put a good, sound retention plan that is, phased on I think 2 years. So to retain them, and this is that kind of affected our cost as well.
Very clear. Just follow-up question before moving to the second question. So I know it's too early to think about next year, but what sort of margin profile we should expect next year, assuming everything is normal? I mean,
I think you answered to the question.
Yeah.
I just want to look at the normalized stuff. I don't want to miss the performance, the great potential that the company has.
I think, I mean, really, we're in a very intense growth phase, right? So, I mean, this year is not business as usual. Next year will not be business as usual either, because we're gonna start up those 10 rigs. So honestly, it's very difficult to answer to your question, what is business as usual? Because it's not business. I don't think that next year is going to be business as usual either, right?
Yeah. It's just, so you see, I mean, we have H2. I mean, H2 is not going to be, better. I mean, we're going to have some
same level,
same level, because you have the start of the 3 rigs that will take a bit of cost, and the rigs will be a bit, they will not be 100% efficiency because it's a new crew together. And then you have to recruit and train. There is a lot of cost that's going to impact you next half of the year because of getting ready for
the
unconventional. And then starting those in Q2 is going to be a lot of cost that's going to impact. So I think it's too early to say. We have to model this in Q4 to see how is next year. But we don't. I don't think. The growth on revenue is in the high teens, I think, from a revenue perspective.
Yeah, from a revenue perspective, we see a growth year on year in the high teens.
Yeah.
We won't reach a business as usual until we are into the second half of next year. So we're gonna have some extra pre-operating costs, and we're gonna have to model them, and where we're going to land. I mean, and, whether it's gonna be where we're going to land is a bit early. But what we can say is that, I mean, for as Ghassan mentioned, for this year, we see the EBITDA level that we have reported at H1. We see the same EBITDA level for the rest of 2023.
Clear. Thank you. Second question is related to the unconventional. It's probably quite long question, and it was partially answered by the OPEX side. First, we see the CAPEX side, it's quite higher, 45 million, compared to the average conventional land. So the CAPEX side is higher. OPEX probably might be the same, but what about the day rate, just for you to end up with the same IRR or the same ROIC? What would be the day rate compared to the conventional land rig? And based on the quick calculation of the 3 billion riyal, the daily revenue rate, not the day rate, daily revenue rate would be around 42,000-43,000 based on my calculation. So if you can elaborate, please. Thank you.
So the 3 billion is the total revenue that you can get out of the contract. So it is the rig rate, you have the mobilization, the rig moves, plus extra charges that we have to the client. So it does not, if you take all of this and divide it by the rate, does not give you the day rate. What we see that, what we see in the backlog, we look at only day rate, and we see that around shy of 3 billion. Shy of 3 billion.
Yeah.
So you're not off, but I think it's in the 40s plus. You're not very off.
But so the 3 billion only the day rate component.
Yes.
So the day rate component is in the 40 plus, low 40s.
Low 40s, yeah.
On average, right? Because there's different type of rigs with different features, etc. So I'm just talking about an average, right?
Average of the 10 rigs.
Average of the 10 rigs, right? And it's still higher than the average of the land segment, right? I think we have already disclosed on the number of calls that we have an average of the land segment in the mid 30s. So we're still higher than the average of the land segment. And the expected EBITDA coming from that particular 10 rig package is accretive to the overall EBITDA of the land segment.
Great. So this is 20% roughly premium over the conventional land, and it's accretive from a bid perspective.
From a day rate, yeah.
Yeah. May I ask the third question, or?
Yeah, yes.
Please go ahead.
Yes.
Perfect. I believe that last quarter you mentioned that the first phase of Jafurah was around 13 land rigs, unconventional land rigs. Yet you have been awarded 10. Is this 10 out of the 13?
Yes.
How many phases? How many 13 would expect?
I mean, so what we know, so there is around just shy of 20 rigs plus us is plus the 13. So you have 30 plus. I mean, our knowledge is we might go up to 40 or 80 rigs for the unconventional. Now, and this is going to be staggered, so it's not going to come all the time. So now we had the 13 tender. We don't know if we know there will be more tenders, but we don't know when and how big is each tender. It doesn't have to be every time it's 13. It can be 5, it can be 10, depending on the request of our client at the end of the day.
Sorry, the 40 to 50 is your share of it, or no, the total, right?
No, this is the total. Yeah. Total.
The total. So your share of it should be higher than the normal land rig, 17%, or should be higher?
So I don't know if you're with us in the pre-IPO. The plan is to see what is right for our shareholders and the business growth. So we're not fixed to the market share. So I'm not because I need to keep this market share. What we need to do is we need to make sure that what is the best to have the best return to our shareholders that we look at. Now today we got 10 of a market of 30 first, but we know it's going to grow. The pie or the number of rigs that are going to be on the unconventional can be 70 to 80 and maybe more. It all depends on our client.
Okay, great. Fair enough. Thank you so much. Thank you.
Okay.
This is very helpful. Thank you.
You're welcome.
Thank you, Ibrahim. And we'll go back to Jonathan. Please, you are unmuted.
Hello, can you hear me?
Yes, Jonathan, we can hear you.
The chap before basically asked the main question I was going to ask. Another question. You announced the dividend for the interim dividend for the first half.
Yes.
Assuming that you make higher earnings in the second half, which I think would be a reasonable assumption to make, would that mean that the likely dividend for the second half of the year would be higher?
So, in terms of dividend, I mean, the board will proactively review the dividends and make the recommendation to the shareholders in a way that makes sense and kind of balance the sustainable growth with the return with the shareholders. So, at this point in time, we cannot we don't speak on behalf of the board.
Okay, thanks. That's it from me.
Thank you, Jonathan. I'll get back to you, Muad, but I have a question in the chat box. Is from Fahad Samyad saying Aramco is set to cancel Middermott offshore contract for Zulaf expansion. Is Arabian Drilling open to bid for the contract and acquire the asset?
No, not really. We didn't have any plan to do that.
Thank you. Okay, we'll go back to you, Muad. You are unmuted. You can start.
Time. So I'm just trying to understand if there are any risks for the unconventional rigs coming in the second quarter. Basically, like my understanding of natural gas is like, gas comes with oil. You have to do something with it, either burn it or transport, store it. So if you're saying that it might begin at the second quarter of next year, is there any risk of delay maybe or something like that? Because there has to be like infrastructure, right? Either you store it, transport it, or something like that.
Okay, so in the drilling, we drill the well regardless if there is a facility or no. So we drill the wells, and the client will have another team, which I think PMT project management, who will connect these wells to a production facility. So regardless if you have the facility or not, you drill the well and the well will be ready for production whenever you want. And what we're saying, H2, you'll start seeing revenue. I mean, the rigs, as you said, will start arriving in Q2, getting them ready, getting them inspected, approved by the client, and moved to the well site. This will take time. And that's why you see the revenue in H2. So drilling the wells has no connection with the facility.
Very clear. So you don't have any risks from that point of view.
Yes. Yeah.
Okay. Thank you very much.
You're welcome.
Thank you, Muad. Ricardo, I'm seeing you raise your hand. You're unmuted if you want to ask. Okay, British, you're unmuted. Please start.
On the 3 billion contract win.
Sorry, your voice came a bit late, so we didn't hear the whole question. Can you start from the beginning, please?
Okay, sure. So I wanted to understand what would be the mobilization costs for the rigs on per rig basis, and is pre-operating cost a part of this mobilization cost, or that's completely different? That's on the first question. On the second question, would 25 million riyals per rig would be good estimation of the mobilization revenues, which you said is already a part of the 3 billion riyals, right? So generally what we have seen is mobilization revenues, revenues are high margin, right? So won't they completely offset any other costs that usually incur in the pre-operating stage? So basically what I'm trying to see is won't would the margins really be quite low when you start off? So these two are my main questions. I'll come back with another question after you answer.
So I'm going to answer that, Priti. So basically, there are three types of cost, and there are three types of different accounting treatment. I mean, you have the project cost, which is the people that are actually, the project team building those rigs. So this is all capitalized together with the rig, and it's capitalized over the life of the asset, which is 20 years. You have the costs that are attributable to the mobilization of the rig, which is basically bringing the rig from wherever it is, whether assembled, manufactured and assembled on the first well location. And this cost is being amortized and deferred over the life, over the primary term of the contract, which is in this case in 5 years. And then you have some pre-operating costs, which are cannot be either deferred or capitalized. And this is, for instance, when we hire the crew. So we hire the crew for all the rigs, and then we deploy those crew on other rigs that we have, to make sure that they train and they're shadowed by they're mentored, etc. And that cost is not capitalized, is not deferred. It's just part of the regular OPEX it's just part of the regular OPEX. So these are the three sets of costs. From a contractual standpoint, I mean, we believe that the cost of the mobilization will be fully covered by the mobilization fee.
Okay. Could you give us an estimate of what would be the mobilization revenue per rig that you would receive when these rigs are deployed? I think we can back calculate in the past. Maybe it's like 25 million riyals. Would you say that's the same for a non-conventional gas-based rig?
I mean, this is not. We cannot disclose. Unfortunately, we cannot really disclose. This is a bit confidential. But let's say that it's as I said before. It's enough to cover the cost. It's enough to cover the cost. Yes.
Okay. Thank you very much. I understand that. Yeah. One last question on the total number of rigs. So as you mentioned, there have been like tenders put out for 20 plus 13, around 33, 35 rigs. And so half of this is done. So do you think we could see another tender as soon as, say, 2024? Or do you think, no, it's like a 2026, 27 story? Just trying to see. You also mentioned that you would win the tenders would be in staggered basis, but any indication of, when probably the next one will come? Thank you.
Are you referring to unconventional again? You're still on the unconventional, yeah?
Actually, you could help us with both unconventional and conventional.
I mean, it's the unconventional. Sorry, the conventional. There is not a clear sight if how many yet that the client wants to add rigs for that. To be honest, there might be a tender here or there, but they're not the real growth that you want to look at. What you need to look at that really, I mean, like the unconventional that's going to go from 30 to 70 rigs. So there is a big jump. It's not like 2 rigs here or 3 rigs here there. So the unconventional, you're right, there will be tenders. We're not sure. I mean, just to give you an example, I mean, when we forecasted for the IPO, we had the plan of a certain number of rigs, but the unconventional was not part of the plan because we did not know when it's going to come. However, it came sooner than we expected, the tender. So it all depends on the plans of our clients and how fast. Now, we know they want to develop this field very, very fast, but so it can be early next Q1 or it can be mid-year next year. So it's up in there, to be honest. But all what we know, it's high on the agenda for our clients.
Okay, thank you very much, Ghassan Hopper. That answers my question. Thank you, Mazen.
Thank you, British. Now we'll go with you, Saleh. Saleh, I'm seeing Saleh want to ask. You are unmuted. You are unmuted, Saleh.
Yeah, hello again. This is Saleh Rakef. So I have a follow-up of one of your answers. So you mentioned that H2 EBITDA should be similar to H1. I just want to know how is that since you are adding 3 new jackups?
Yeah. So I'll explain and then. So we see that there will be a couple of one-off costs that's going to happen in H2. One is some of the cost, you have when you start a new rig, there is a bit of extra cost of you call it startup cost for the rig to start and until the crew is aligned, because you have full crew on the rig that needs to kind of gel together. So it takes a bit of time. So this is for the 3 offshore rigs. But the real major cost that I was trying to explain, there is a huge headcount that I need to add. 16% of my headcount needs to be added just to be ready for the 10 unconventional rigs. So this headcount that's going to be added, there is no revenue against it. And not only the headcount is going to be added, and then you're going to really expedite the spend on training and development to make sure they're up to speed and ready for the operation when it starts. And for the rigs, it's you cannot train someone over a week or 2. You really need to put him, for a couple of months to get acquainted, experience, and has good knowledge to be part of the crew on the rigs that's going to start the 10 rigs. So we see this cost that's going to happen in H2.
Many thanks. Very clear.
Okay, thank you, Saleh. Okay, Dana, you will be the last who would ask. I will take Naif, then Dana, and you will be the last participant. Thank you. Naif, you're unmuted. You can start.
I have a question more on the business side, and please clarify if I'm mistaken on this. But Aramco's policy, your key client, is basically they try to maintain their reservoir, right? So if they're going to produce 1 barrel, they're going to drill for 1 more barrel. So my question becomes, is in Q3, for example, we're going to have oil production of roughly 9 million barrels a day. So if we exclude basically their plans on increasing the maximum sustainable capacity, then logically speaking, shouldn't the utilization of rigs fall?
So if theoretically you're right, but you have to understand is when you explore, let's say for example you produce 1 barrel and you want to explore for that barrel that you produced. Not every well that you drill, you have a success. So you really need to continue drilling. That's one element. The other element, the decision to drop production this is minor in the whole scheme of things when you manage a reservoir and try to find more reserves. It's a small changes that Aramco is very, very, long-term planning. They don't look at these small ups and downs that affects the day-to-day operation. I hope I did answer your question.
Naif, clear?
Just to be clear, it's not a straight calculation. You drop production, then drop the drilling. It's not correlated straight up to it.
Okay, no, that's clear. So you're saying in the grand scheme of things, it's not major, but there is a minor impact, or there could be a minor impact.
I mean, this would be with a client other than Saudi Aramco, yes.
Yes, but
not Saudi Aramco.
Very limited, yeah.
Thank you.
Yeah.
You know, the last questions from Dana. Please, Dana, you're unmuted.
Capital. So 2 questions on the unconventional starting in next year. So what does the ramp up look like, especially that you've just highlighted the overruns? And it's a big contract, amazing job in winning, but what should we expect on the margins going next year? So that's the first part. And secondly, since I'm the last one, I'm gonna ask all at once. On the international front, I'm not sure if you have already talked about it, but the IPO guidance of the 10 rigs international, What is the update and if there is any change in the strategy? Thank you so much.
Let me cover this. So let me take the second question first, then I'll pass it to Uber for the margins. So you're right. If you go back to the pre-IPO guidance, what we said is we will have 4 rigs offshore. We will have 10 rigs, expansion out of the kingdom. And we might have plan a growth on land from 5 to 10 rigs. So what did we achieve today? Today we achieved a 10 rigs, which is instead of the expansion out, is in Saudi. So during the IPO, we said they will be unconventional, but we didn't forecast because we didn't know when it's going to come. So the unconventional came faster. And when we look at the expansion out of the kingdom and the unconventional, we can realize that the unconventional was more accretive. So we decided to win the unconventional for 2 things. One, it's a better deal. Number 2, it's very strategic. It's good for the kingdom and it's sustainable. It's here for a long time. If you look at any contract outside Saudi, might not have the same length of operational time like the one in unconventional. The unconventional is going to go for years and years and years. So it's better to be. So we decided that we will take this. So what we did is we exchanged the 10 rigs going out of Saudi with the unconventional, which is a better deal that we see. And what additional to, we won an extra offshore rig. So instead of 4, we won 5. So there is 1 additional offshore rig. This additional offshore rigs is almost 4 land rigs. So if in all scheme of things, we almost delivered the 5-year plan in 1 year.
So I guess there was a question on the margin. I think we have already answered that in the sense that we have indicated that from a cost standpoint, we have modeled the operating cost to be the same as the land rigs, simply because we don't know, we cannot at this point in time we cannot quantify the potential upside that we're going to get from synergies. It's a bit too early. So that's one thing. And I think on the day rate we have already answered. I mean, we have said that the day rate will be in the low 40s, and and we have confirmed that it's it's slightly accretive compared to the average of the land segment. So I think you have all the elements.
Did we cover your questions, or you want us to repeat it?
Can you talk, Dana?
Yes, I can now. Yes, on the ramp up. So all of the 10 rigs will start all at once, or is it going to be a gradual?
No, I mean arrival gradual, but I think we're seeing that the revenue will start in H2.
Yes. Okay.
Arriving of the rig doesn't mean that you generate revenue.
You're not going to get all of the 10 at once.
Yeah.
Well, there's going to be they're going to arrive at once, but there's going to be a phase you have to go through in the client's acceptance process. I mean, there is a process that needs to kick in, and what we're saying we see the revenue flowing into H2.
Okay, thank you.
Thanks a lot, Dan. Thank you all. Thanks a lot, Arabian Drilling Management, for participating and clarifying and addressing the inquiries. Thank you all for participating, and have a nice day.
Thank you.
Thank you.